Hi, everybody. My name is Stephanie Baxter. I am the Director of Programming and Engagement at the New Hampshire Tech Alliance. Welcome. We're glad you could be here today. For those who are not familiar with the Tech Alliance, we are a technology association in New Hampshire. The tech industry is a $13 billion industry in the state and one of the third largest industry in New Hampshire. So we're here to support the industry and help it grow. And one thing we do to help it grow is supporting startups and entrepreneurs across the state. So we were excited to launch some new startup programming in 2022, which include our office hours for startups, where you could meet with subject matter experts in a variety of different areas. And these happen monthly, the last Thursday of every month. We encourage every startup to take advantage of it. It's a nice 30-minute conversation, troubleshoot a problem you're having, get some advice. It's a great opportunity. And we also launched a resource guide on our website for resources within New Hampshire to support startups as you're growing and scaling, whether it be just looking for a co-working space or looking for some business advising, some finance opportunities. It's all on our website now, so be sure to check that out. And then we have webinars like this. So this one in particular is called Startup Funding Explained. It's a 3-part webinar series and has been sponsored by Cook Little. We can't do any of our programming without our sponsors, so we're very appreciative of Cook Little to sponsor this today. This is the first part of the webinar series where we'll look at the different types of financing that are available and when's appropriate to use it. Next Wednesday at noon, we will be talking about the pitch and how to create a pitch, what to look for, what to include. And then the final one will wrap up with different ways that startups have used funding that they've received to grow and scale their businesses. So I'll pop a link to the others in the chat if you'd like to sign up for those. Just a few logistics. If you have not been on Remo before, there is a Q&A tab on the right-hand side. So we have chat, feel free to chat. But any questions, please pop them over in the Q&A tab. And then we are recording this, and the whole point is to have these webinars as a resource on our website for startups to refer back to when they are getting to the point where they need funding and don't know where to start. So this is recorded today. And I'd now like to introduce Emily Peniskovic, who's a corporate attorney at Cook Little. She's also an Alliance board member and co-chair of our startup committee. So welcome, Emily.
Hi all. Thank you for joining us, and thank you for the introduction, Stephanie. So as Stephanie mentioned, today we're going to kick things off, kick off this 3-part webinar by talking about the most critical piece. What are the different funding options that early stage companies can look towards? And so today we have an awesome panel. We have 3 different people, and Stephanie, are you going to go ahead and loop our panelists in? There we go. Excellent. So just a quick introduction of each of our 3 panelists, and then I'll give a quick overview of what we're going to talk about today, and then we'll just dive into the conversation. So here with us today, we have Kendra Bostick, the co-founder of Kikori, which is an education app focused on experiential and social emotional learning. And Kikori was actually featured in the Tech Alliance's last Innovation Summit. And as part of that, Kikori received investment from the Millworks Fund, which is a New Hampshire investment fund. So I'm sure we'll be hearing more about that shortly. And next we have Joe Raczka, who is Chief Investment Officer, Managing Partner, and co-founder of York IE, which is an early stage investment firm here in New Hampshire that also has a particular focus on B2B SaaS companies. And third, we have Joe Bator, Executive VP and Chief Lending Officer at Primary Bank, which is based in Southern New Hampshire. So 3 very different perspectives that will be really helpful to collaborate here. So just before we dive in to the panel conversation, I just wanted to provide a quick overview of this topic. So for really early stage companies, finding funding and figuring out how to cover all of the company's expenses is the top challenge, I would say, in 99% of cases. And when we talk about this, we're particularly focused on product businesses, simply because usually product companies are in the specific challenge of needing to find funding to bridge the gap until the product is actually launched and revenues coming in, as opposed to service companies that might be more readily able to bring in some of that revenue. So very early on, initially, a lot of founders might be in a position where they can at least bootstrap a portion of the money that they need. And then usually the first people that they turn to are friends and family. And part of that is, usually the friends and family of the entrepreneur are really looking to support the entrepreneur. They're not looking for the same kind of return on investment that your later stage investors are. So they believe in the person behind it all. They want them to do well. So that's a lot of times where some of those first dollars are coming from. But usually that doesn't get early stage companies, all the way to the finish line. So then typically companies will turn to a few different options, including angel investors. And angel investors are accredited individuals who invest their own money in early stage companies in exchange for some kind of ownership interest in the company. And similarly, we also have venture capital funds, which are firms or companies that pool money from groups of investors into a combined fund. And generally speaking, VCs are able to take on a little bit more risk than angels. So you'll see the dollar amount of the investment size larger, but typically in connection with that, VCs are taking a little bit more of a control stake in the company that they're investing in, and we'll dive into all of this in more detail in a bit. And finally, we also have the option of finding bank debt, and we'll definitely have some questions for Joe on this, because that's a kind of a unique piece for really early stage companies to go after. So we'll hear more about that. So those are some of the sources of funding. But in terms of forms of funding, one option is the company can sell an ownership interest in the company. So VCs and angels are typically going to be looking for some preferences that come with that. So we typically call that preferred stock. Another option that is very popular among early stage companies is a convertible note, which is a loan that is convertible into equity at a future point, typically upon the closing of an equity financing that happens before that loan matures. So in that sense, it's kind of like a pre-purchase of preferred stock. So wanted to give you at least that brief overview of some of the terminology that we'll be diving into in our questions here. So with that, I'd like to open it up to the panel. And to kick things off, and we have two Joes, so I'm going to do my best to differentiate here. But Joe Raczka, so one thing that I think a lot of early stage companies have to deal with is, when are companies ready to even approach an angel or a VC?
It's a great question, and thanks, Emily, and thanks everyone for joining today. I think the definitions of funding have obviously varied and changed over the years, and we're in an environment again now today where those definitions continue to change in terms of stages and when people raise capital and when they don't. But to answer your question directly, I think when is a startup ready? Well, it's when I'd say the founders are ready to make a full commitment to building a business. I think what you've seen, especially through a pandemic where remote work has changed some of the dynamics, you've seen folks doing things off to the side, starting new businesses, new side gigs, and tinkering with perhaps a spin-off of a product or whatever their interest is. And while that's great and we love innovation, I'm not ready to put money behind anyone unless they're fully committed and ready to go. So it's as simple as that. And you see teams of folks or individuals get funded when they just have an idea and a pitch deck, perhaps. But, I'd say that's more your sort of friends and family round, early angels, where a firm like York IE comes in is more in the pre-seed, seed, and, in the typical definition, there's then a Series A, but we see more like seed plus and bridge financings now that sort of sit in between that seed stage and Series A. And what we're looking for is, a solid team, solving a problem based on some experience that they've had, right? Some sort of prototype, working product, some maybe early indicators of a go-to-market strategy, and a repeatable use case to go sell upon. So it all sort of varies. But again, I think really the simple answer to that question is when a team is fully committed to building a business.
Excellent. And for Joe B, I'm assuming the parameters for when an early stage company is ready for bank financing are very different. So can you speak a little bit as to when it would be appropriate for an early stage company to turn to a bank?
Sure, and that answer varies really between based on founders and other things. Is this a first-time founder, or is this a repeat founder who's done it before and maybe has some net worth that they could pledge? Do they have a home that they could pledge, which would allow someone to come in earlier and not give up equity? One of the keys with bank financing is we're always, certainly in earlier stages, are going to want a full recourse. We want a full guarantee from the founders, the principals, the primary owners. So you're certainly betting on yourself, even more so when you go to a bank, but you're also retaining 100% ownership because we don't take an equity stake. More typical though is when you either have inventory, a product that, and maybe it hasn't gone to market yet, but you have purchase orders for it going to market. You can sometimes get effectively inventory financing, purchase order financing. A few years ago, I was working with a group of MIT students who built a better mousetrap that they were going to be selling to the federal government. The federal government put an order in, but they hadn't actually delivered any product yet. We were able to finance that. They were able to retain 100% ownership based on that, contract with the federal government, and that they have since built a multi-million-dollar company, and were able to do it without going into the venture world. So they retain 100% equity, which was great. Other places where you have recurring revenue, maybe you're not cash flow positive yet, but we can understand how your cash flow can repay the loan if you stopped investing in R&D. So you might have a dual strategy where you're cash flow negative, but that's because of your investment into additional growth. We can bridge that gap a little bit and provide some financing for people and utilize some government programs as well, SBA and whatnot, to do that.
And that's a good point. Aside from traditional bank financing, are there like hybrid solutions or unique solutions that are tied to bank financing that early stage companies could consider when they're not ready to give up ownership?
Yeah, certainly the SBA is a great one. There's also some other ones in New Hampshire. Various states have different things. The Business Finance Authority, New Hampshire Business Finance Authority, is a place that for certain niches that they're available. Community Loan Fund, another one, under certain scenarios. Typically job creation is one of the big things in the state that states tend to provide money for, that allows opportunity there as well. But start with your banker because they can direct you.
Great. And so we've now heard about a few of the different options that exist. So Kendra, I would love to hear from you about what your experience has been as a founder going out and considering all of these different options that exist. How did Kikori navigate this?
Yeah, so I was writing all of the different things that we've actually done. I've got a list of, like 9 different things that we've done in order to finance. And we call our experience our entrepreventure. And we really look at it as an adventure, and we're trying to figure it out. It is, as Joe mentioned, there are some people who've been an entrepreneur before, and of course, it's a lot easier for them to understand how to navigate to be able to come in and have those past experiences to call on, as well as, their reputation and the fact that they've done this before. In our particular example, I'm a former school social worker. I was a school social worker when I had the idea for the platform, and it was kind of an idea that I couldn't not do. My co-founder is an adventure coordinator at an expeditionary learning school. And so we had no training in entrepreneurship or in technology. And I think that there are, a lot of wonderful ideas out there from folks that haven't necessarily been trained in this area. And so it's really important for me to be able to share all of the different, opportunities and ways that you can, ways you can finance and ways to think about it. We started off as an LLC, so that's the easiest way to found a company. And thereafter, we, again, in our entrepreneur venture, explored, are we a nonprofit? Are we a for-profit? Interviewed a lot of different folks in both of these fields to find out which one we were. As a for-profit, we then had to make the decision about what type of for-profit, and really signed up for, kind of anything that came our way. I'm a doctoral student at the University of New Hampshire. And so through the Entrepreneurship Center there, as well as the SBA, I was connected to the New Hampshire Tech Alliance. And again, a lot of the programs here really supported us in learning about funding, about how to meet investors. So we became involved in a number of competitions. So that's one funding source at the University of New Hampshire, won 2 competitions. We also applied for grants. The National Science Foundation I-Corps was another program that we did through the University of New Hampshire, which provided us with grants, as well as some grants to apply for the SBIR, and the STTR is another program that's available. There are a number of accelerators and incubators that you can also get funding through. We did a Kickstarter as well, which is a crowdfunding platform. This was something that really helped us build out, our product and figure out how we were selling it. We did a friends and family round with a number of our advisors, as well as some close family members. Throughout everything, we've always been kind of bootstrapping with our initial product. We actually traded English lessons for app development hours while I was living in Chile. So that was one of the ways that, trade economy at the very beginning. As far as really needing that funding, you mentioned that folks who have services don't need the funding as much as others. And so that's one where I'd recommend anyone who has a tech product to have a tech co-founder. It's one of the ways that you can bootstrap the longest and, really make your money last just by kind of working extra hours. And yeah, we ended up, one of our advisors worked in Silicon Valley and had a really great understanding of investment. And so she's the person who really pushed us to incorporate as a public benefit corporation, which is basically a C Corp. And she was the person who said, investment is really the way to go. And so I think, taking what Joe was saying about how you have to be committed, I think there are really 2 ways you have to think about it. First of all, you have to think, yes, I'm going to get this funding tomorrow, because you have to be all in as an entrepreneur. And the reality is that it can take 12 months. And so you really have to be able to hold both of these ideas in your mind at the same time, and be come into every pitch, come into every meeting with your pitch deck ready to go, and just learning from every single event that you take part of, as well as having the knowledge that, it may take a long time. And so our first event was the Speed Venture Summit offered through the New Hampshire Tech Alliance. That's where we met our investors, who ended up 1 year later investing in us, being our lead investor, which has led us now to raising $300,000 through angel investors. So long story, but a lot of different steps in our process to getting where we are today.
That is one of the most perfect examples of how all of the different options, you guys have really touched on almost all of the different core options that startups have to consider. So it's really interesting to see how you work through that, and to some extent, the order that you worked through those options as well. And did you have certain, I'm sure this was a lot to navigate. As you mentioned, you came from a social work background. This sounds like a lot of this was new to you. How did you navigate this, or who did you turn to help navigate all this?
Yeah, so our motto for our first 2 years was hashtag thanks Google. And so we really, we Googled what is a pitch deck, what is ARR. So we went to the internet, but it was really our advisors. So we were able to bring on a core set of advisors and just, kept our eyes open for anyone that we met who had experience in this. And the University of New Hampshire is another place where, week one, I was connected with the Entrepreneurship Center and Ian Grant. And so he really introduced me to an entire world of opportunities, helped me with my pitch. And yeah, I mean, I think that was, and that was one of the other things is, again, I wouldn't necessarily recommend getting your doctorate right while running a startup. A lot of work, much better done if, there's a pandemic going on. But if you are at a university, there are so many opportunities available for young entrepreneurs as far as hackathons and ways to meet people. So that's definitely, if you are, a new entrepreneur at a university, tons of different ways to get connected. And the SBA is another place. Julie Glossner and Andrea O'Brien have, had amazing support towards us and helped us, introducing us to lots of different folks in New Hampshire.
Awesome. It really does take a team behind the founder. This is a perfect example of that. And we actually do have one question from a viewer, and that's a good reminder to other viewers that please feel free to chime in with questions in the either in the chat box or the Q&A box. But so Kendra, you had mentioned that Kikori is a benefit corporation. And so the question is there a downside to being a benefit corporation from an investment standpoint? Are investors concerned that a benefit corporation may provide a lower rate of investment return? So, and also if others, feel free to weigh in on this as well.
Yeah, so we are a public benefit corporation. There is also a certification called a B Corp certification. These are two separate things. We are technically a C Corp with a social mission. We also have actually done a lot of work with the B Impact Clinic at the University of New Hampshire. They have an amazing program to build out our B Corp certification roadmap, which is a huge application process we're still working on. But with that, you also get all of the best regulations for your workers, for your customers, for the economy. There are a number of investment organizations which focus on impact. So there is actually an entire world that opens up. Again, in our particular instance, we're a C Corp, just like everyone else with a social mission. I believe that social responsibility sells. So I am in it because I care about it, and I care about people, and I care about the environment and schools. So we are an EdTech platform. Schools are more interested and trust us more because we care about these things. And there is also, just a huge movement towards social responsibility and corporate responsibility. So I believe that it is only an asset for us and going forward. And that there is an entire, group of folks who are also really focused on promoting this and who are extra behind us in our efforts.
And then I guess from the investor/bank side of the table, is there anything, I guess, to add there in terms of, so for benefit corporations, their mission is, so, for a typical corporation, you have to maximize shareholder investment. That has to be one of the goals of the company. For benefit corporations, there's also this added social impact that Kendra's touched on. Is there anything to add from an investor standpoint? Is that a hit on the company or not?
Yeah, I can't say it's something we've come across yet. Obviously know about it, but have not made any investments in those types of companies. Joe Bator, I don't know if you have a different opinion there.
No, we've seen it as well. It doesn't impact bank financing at all. It's just there's a bunch of different structures companies can take, and we just need to understand it. It's more about, from a bank standpoint, we just need to understand who the owners are.
Right.
The government requires you to get down to a person eventually. So, depending on how many layers and investors you have, we always got to find the individual who has control and their ownership percentages.
And I can add that in, when meeting with investors, the requirements as far as having a strong go-to-market strategy, having strong product market fit, none of that changes as far as what investors are expecting out of us as a company. So it's still important that we demonstrate that we are, bringing in revenue and meeting all of those same qualifications.
Joe Raczka, I wanted to turn back to, so when you were talking a little bit about when startups are ready for more institutional investors, you had touched on some of the different stages of funding, and you had mentioned a term that gets tossed out a lot, this infamous Series A. Can you talk a little bit about, just for those who may be really new to early stage funding, what the difference is between a seed round and a Series A, and what those different stages and the goals of those funding stages, how those play together?
Certainly. Yeah, I'd say in the earliest stage or stages, right, there's probably the 3 or 4 buckets that I mentioned, right? The friends and family, the pre-seed, then seed, and then sort of your seed plus, bridge financing. We're seeing more of those and more to come, and I can expand on that. And that's really all about, team building a product, a prototype, finding, sort of that minimal viable product, MVP we call it, figuring out, buyer personas, ideal customer profiles, understanding market sizing, how big is it, what's your target market, what's your total addressable market, understanding competitive dynamics, and being able to prove out some concepts with your product with potential customers, and getting that customer feedback loop, which I think is all really important in those that first seed stage. We'll overgeneralize it to the 4 things I mentioned. And oftentimes, that doesn't mean any revenue quite yet, to be honest. Some do have some early traction, or either free trials or paid trials, but understanding product usage, right? How engaging is your product? Does the customer start to think of it as a nice to have versus a need to have? So these are all those concepts that you're really working on proving out in those earliest stages. Series A investors, and again, to be honest, obviously everything here is happening in real time. I think the goalposts for Series A investors have moved, even over the last 4 to 6 weeks. So you're seeing those goalposts push out a little bit. I think the magic mark used to be $1 million of ARR, $1 million of revenue, sort of in that sweet spot before you go out and raise your larger and more substantial Series A round. I think we're seeing that kind of push out a little bit to the $2 to $3 million ARR mark, still with exceptional growth as well. But that is, a solid number of customers at a proven price point, at a repeatable use case, right? That a go-to-market team, you can quickly see some signs of it's time for investment. I can pour fuel on the fire, and I can go grow and scale a business. Those are the indicators for the Series A, and that's critical. And I think, as we talk through again, I'm sure we'll get into it more later, but sort of the macro factors and what's happening now. What used to be the case is, great, thanks for those signs. Here's a bunch of capital. Go grow as fast as you can and spend as much money as you want in order to achieve those best-in-class growth rates. I think now there's going to be a much more pragmatic, here's some capital, go grow responsibly, understand the unit economics of your business and the levers to push and pull in order to get closer, or at least tell me when that path to profitability is, and or extend your runway beyond what you thought you were going to raise money for, which was a 12 to 18 month period. Can you give me some confidence as an investor that perhaps you can push that to 18 to 24 or even beyond 24 months if these sort of downturns, economic cycles come through a little bit and we have to preserve optionality. So I threw a lot in there, but that was intentional. I think the key point is the goalposts continue to change. And so it's important to sort of pay attention to what's going on around you. And at the end of the day, building a business with strong fundamentals and understanding the economics, the metrics, the KPIs will always be key. And customers are the best way to fund a business.
And let me jump in as well. Not necessarily financing, but certainly banking related. The second you get that first check from Joe or somebody else, you need a bank, because that money is going to go into a bank, and you really need to start building a relationship with a bank. Very often someone gets that check, they walk into the closest bank because they're terrified about carrying that much money around, and immediately open an account, and that becomes their account. But that's not necessarily the best fit for them. So I would encourage you to figure out where the best fit is, find your banker, talk to your, talk to the Joes of the world and say, where do you bank? Where should I be looking? They'll give you some good advice, because ultimately, as you grow, you're going to need a bank on that financing side, if not initially. And if you've already built that relationship, you already have deposit accounts, the bank already knows you, they can help you navigate that well. They can also help you find additional capital. They can make it easier for you to pay people and do a lot of different things that you're not necessarily thinking about when you're thinking about creating your minimal viable product.
Thanks, Joe. And that is actually kind of a good segue to one of the questions that we just got. That's a good example of how a bank is a really important partner for the company and helps in more ways than just going out and getting a traditional bank loan. There's another side to that relationship. And so from an investor perspective, Joe and Kendra, I'd love to hear you weigh in on what value add, other than just the check that's written, can entrepreneurs expect to get from a funding source? So that was a question that we just got from one of the viewers, but I think really nicely ties into the conversation.
So our investors are really, really close with us, our lead investor, and honestly, she's, made a huge difference in our entire company. So I think that it is something to think about when you are, meeting with your investors, and finding someone who really connects with your product as well. But yeah, we've got our board of director meetings, but they help with funding, financials, relationships, support. I really see kind of the natural tensions. So our investors are always, 10 steps ahead, like pushing, encouraging. And while it's not always easy, it's really important. And we need that relationship to help us, keep driving. And their eyes are always on, the revenue and traction. And so, yeah, those are just a few of the things that we've been able to get from our investors.
And I can add, so I've got the perspective of both an operator as well as an investor, right? Having raised over 100 million for Dine and now investing in early stage. Listen, when the check is written, that is the starting point of a long-term relationship. And so you need to make sure that the relationship you're entering into is made up of complementary pieces. And so, from the operator's seat, I think, it's very important to make sure the complementary pieces are there in terms of, are you a technical founder and therefore you need someone on the other side of the table that might be more financially savvy or more go-to-market and marketing focused? Or are you that go-to-market leader who needs someone with a little bit more, perhaps, market credibility? So you're a cybersecurity company, go find an investor that specializes in cybersecurity, right? So just sort of drawing out that map of strengths and weaknesses, I think is really a key part. And as you progress through the stages, obviously that changes. So the early days, perhaps your angel investors happen to be, the doctor or the lawyer, right, who wants to dabble in an alternative investment. So therefore, they might be great mentors and friends and supportive, but may not know your market or how to build a, SaaS business. And as you progress, obviously, again, you'll get more resources from an investor. I mean, this is the whole basis of our model at York IE and our niche that we've carved out. We noticed that most early stage investors don't have the ability to be heavily involved. There's multiple reasons for that. Either they're small funds and they are the traditional fund model, and therefore it's only a few employees at the fund, or it's a massive fund that writes small checks in order to be a participant in the later stages as the company just figures it out. But for them, it's not scalable to give enough attention to the startup, and so they have to take a very passive approach. We've sort of built, this vertically integrated, hybrid advisory and investments business for the early stage, and we, mapped out the biggest areas of need for startups, and we've built services, advisory services around each one of those topics. So everything from marketing and communications to the go-to-market help to HR and recruiting, to marketing competitive intelligence, and even R&D, so product development work. And we can plug in and solve, do some gap analysis where a startup really needs help and plug different people, functions, helpful people, around the table to plug those gaps. So I think it's incredibly important for founders to search for complementary pieces and investors that bring more than just a check. Again, 2, 3, 4 months ago, I'd say raising capital is somewhat easy. There's plenty out there. Obviously, again, we're in this changing environment, so perhaps that definition changes. But we see from the most savvy founders, oftentimes repeat founders, that they're seeking investors that bring a lot more to the table other than just capital.
And do you have suggestions for how an entrepreneur can assess investors and whether the investor will be a good partner? Kendra, I'm sure you've had to deal with this as well from the founder seat. So how did you navigate that?
Yeah, with our lead investor, she's from Maine Angels, and she was a former school counselor. So she really connected with our product and really understood how important and, necessary our product was. She was very communicative and, kind of just always, showed up. I do think that it's important to assess as well as to remember that we are 50% of the relationship. So, for me, it was also like, we also have to be dependable. We have to show up. We have to, take advice when it's given, ask a lot of questions. So I feel like that's half of it.
That's a very organic, a very organic synergy that you had with that investor. And so I can imagine, where there are different options, you're either going to feel that fit pretty early on or you're not. And thankfully, in your case, it seems like this was a pretty immediate fit. But, to Joe's earlier point, ideally investors are contributing more than just a check. So it's good not to be in that position as a founder where you're just taking the first money that comes across the table. Holding out can definitely have its value as well.
Yeah, I can add too, just from the founder seat, right? I think it's important to do your research, learn about the investors. They're clearly going to perform a lot of diligence on your business and on you personally. So you should be doing the same. It's a two-way street. Talk to peer networks. That's why it's also important, to Kendra's point earlier, to put the right types of advisors around your businesses from the early start. You get the intro from the Emily or the Joe Bator to, an investor that's helpful and that's a trusted network from day one. So again, building out those advisory networks as well as speaking to other entrepreneurs through peer networks. I think that stuff's incredibly valuable. Again, sometimes it probably seems like you should just be focused on building your business, but all of those pieces need to be in play in order to optimize.
Yeah, and I think the other thing is don't discount that, the people behind the scenes are talking to each other. It's, Joe and I talking about, Joe might get a referral in and he might ask me or ask a CPA that they work with or someone else. We're constantly in communication about various things going on, which helps everyone. But if you're not doing your due diligence and you're not doing your homework, you can get left out on that for sure.
So we've talked a little bit about the fact that when investors come in and get involved, there's involvement in the company ideally and some level of control over the company's decisions. Joe, could you talk a little bit about, what other preferences angels or VCs are going to expect? They're not just simply owning equity in the company. There's a little more to it than that. And what can entrepreneurs expect, generally speaking, on that front?
Yeah, I think at a certain point in that cycle, obviously, a company puts a formal board in place, board of directors. Typically, the lead investor in that sort of seed round will ask for a seat on that board. My advice, again, operator hat versus investor hat, keep that board small in the early days because it will grow over time. You don't need too many cooks in the kitchen. But I think the expectations are, sort of the way I approach it is, listen, we want to be your first call. If something is a mess, wrong, or good, let me know, right? Make us your first call. I don't necessarily need to over formalize it in terms of let's meet quarterly and give me the readout and the updates. I'd rather be in flow with you. Again, that's probably because I'm an operator, now investor, right? And so that's sort of the way that we behave. But I think, the founders, management teams, entrepreneurs need to know that once you take that check, it's an open book. So you're not the only one with skin in the game. And each investor is unique and will have different demands and requirements. And at the end of the day, it's just more about transparency. And it's the classic, the advice to the founder is deliver bad news first. Don't let the investor figure it out later. That's a much longer conversation we could go into, but I think those are sort of some of the key points.
Excellent. So we've talked a lot about different sources of funding. I guess to turn to the forms of what form that funding can come in. So we were just talking about, selling an ownership stake in the company to investors. Can anyone talk a little bit? Has anyone had experience with convertible notes and that alternative? Kendra, I see you nodding your head.
The pre-seed round that we did is a convertible note round.
And was that, did that, or I guess, how did you decide to go that route? Or was that decision made for you? Was that something that you were aware of before that option presented itself, or was that new to you?
Yeah, so we knew that the first round is generally a convertible note or a safe note. And our lead investor preferred convertible notes. It is interesting talking with people, and there are some people who are really passionate about the safe note, some people who are more passionate about the convertible note, but our lead investors are more comfortable in that sense, and so we went forward in that way.
And for those who are tuning in, just a little more background on the difference between convertible notes versus safes. So both of those vehicles are essentially a loan that can convert into equity at a future point. The safe, which essentially came out of the West Coast, so it's in my experience, has been more popular there. I think investors in New England, we'll focus on that specifically, are a little more hesitant and just less comfortable and familiar with it. So they definitely do come up, but I think they're much more popular on the West Coast. But one of the key features that the safe doesn't have that convertible notes do is it doesn't have a specific maturity date baked in. So that's also something that some investors might say, I don't really know how I feel about that. But in any case, both of those are similar options where if the company has an equity financing before that maturity date hits or at some point down the road, then that loan converts in. And the investors who signed on and did a convertible note, part of the benefit that they get for coming on early is they'll usually convert at a discount. So that's the upswing for the investors to get involved.
And there could be an interest component there too. But, I think the key on those two elements, again, it's for the earliest stages. And SAFE is a simple agreement for future equity. It came out of Y Combinator, simple one-page document. From the founder seat, both are super easy to execute upon because they don't require a ton of upfront legal costs. Priced rounds, preferred equity rounds will require a lot more in terms of legal work. So you can get away with putting those in place relatively cost effectively. And they're easy, and they're one pagers, and they're simple terms, and you don't need to get into the board seat stuff and all the other things, the voting agreements and all that stuff we talked about. So pretty clean and easy. I'd say from the investor seat, again, we probably tend now to do less convertible notes and safes than we did as angel investors, quite honestly. We prefer to price in the sort of seed and above range. Just makes it cleaner. It draws a line in the sand. Everyone can jump on board. The company then, converts to a C corp, can start to issue options for employees. So it's a level of maturity that I think we tend to encourage companies to do ahead of time. And one other quick point on notes and safes. What we are seeing is even if you do a priced round initially at the seed stage, if there is a bridge round after that, can be done on a note or a safe. So that's becoming a little bit more typical as well. Again, discount component, so there's some elements that are attractive. I've got the elements of why it's not attractive, but that's a different conversation as well.
The other thing to note when you do a convertible note or a safe, if you get bank financing, you're going to have to subordinate that to the bank typically. And we're dealing in the case right now, someone who has a convertible note, they're hoping to grow dramatically, but they have a product that's shipped and we're giving them effectively inventory financing. They have a purchase order of $170,000 for delivery of the product, but they're going to have to subordinate. They're going to have to get their investor to subordinate the convertible note to the bank so that we can actually perfect our interest in the collateral. So that's just something to be mindful of as you approach banks if you have that form of structure.
That's very helpful. Just to talk about some numbers, Joe, I think you made the point earlier that the goalposts are shifting for different investment sizes. But I guess generally speaking, what can a new startup expect to raise in an early investment round in terms of dollar figures? So I know that's going to be different. And Joe, I'd love to hear too from a bank's perspective, what size loan is something that the bank's even going to consider early on?
Yeah, I think from our seat, again, probably a stage ahead of where York IE comes in, and Kendra may have better answers here, but that friends and family round is typically in the 200 to 500K range. I think when you get into your sort of pre-seed round, you're now talking a couple million. Now, instead of just putting round numbers on it, I'd also think about it in terms of your financial model and how much runway that gives you from a cash break-even point. That's the more important way to think through it. So understanding, how much you need to achieve the next milestones is really the dollar amount that you should focus in on versus the, sort of average number for what a pre-seed is versus a seed versus a Series A. So that's my quick answer on it.
Yeah, and I would jump in as well. It really depends on the need. In this instance, we had someone who needed to buy $170,000 worth of inventory, so we were able to give them a loan at just under that to get them started. We've done loans as small as $25,000 and as big as in the millions for startup or an acquisition. Another one, an early stage company. Sometimes you get it; they'll have an acquisition that makes a lot of sense, and we provide financing for a portion of the acquisition as another way to get bank financing in without having to give away some of that equity.
And yeah, our friends and family and crowdfunding was around 50. And then our, a seed round is 800. We've split it into 2 tranches. So we raised 330 and we're looking to finish it out with another 500. And I would agree that the most important thing is to look at your budget and understand what roles you need and have that be the driver of your funding rather than, kind of what's typical. For us is we are doing a convertible note round, which means that we will be doing an equity round. So it was important to build out 2 years in order to really calculate those and be able to share with investors what our plan is for the equity round as well.
Excellent. So someone earlier mentioned, I think it was you, Joe, that essentially finding funding or going through this process takes longer than you think. And we've talked a little bit about the runway and how important that is to factor into the calculations. what can you say to entrepreneurs in terms of how long does it take to raise capital from start to finish?
That's a great question. It all depends. It's all different. I'd plan on, again, this is probably the 3 month ago view, maybe not today, but it's a minimum of 6 months. It's a long journey. It's a big process. If you want to do it right, if you want to find the right match and investor, you need to invest the time as a founder and make sure you talk to enough people. I have some stats sort of in my head from a great company that's just about a unicorn status out of Boston, but I remember the founder telling me that he conducted over 150 investor meetings for his seed round. I think before he got one yes, I think it was 75 or so, for his Series A, and then 15 to 20 for his Series B, and now it's much easier. But it requires a massive time commitment, and again, in today's world, I think you'll see as the goalposts move that there'll be higher expectations from investors now, and it might be hey, great business, but come back to me in 3 months when you've achieved X number of customers, Y revenue, and some more sure telltale signs of product market fit. So make sure that you've got plenty of runway, because the last thing you want to do is be out there raising capital with 1 or 2 months of cash in the bank when then your back's against the wall and you have no negotiating power against your investor. It's a bad place to be in. Again, there's sources like the primary banks of the world and business loans you can go seek to extend runway, but it's a challenging time, and make sure that you have plenty of runway to figure it out and to optimize.
And we have just a few more minutes here. So, and I hope I'm not ending on a negative note, but Joe, you've mentioned a few times just how much things have shifted even just in the last quarter. And I think that's a reality that is worth addressing for the last few minutes here. How do all of you see the current volatility in the market affecting what options startups have and this traditional process in the coming months, year?
Yeah, it certainly is interesting. I think, obviously you've seen multiples contract in the public markets. That's making its way into the private company, market, down into the earliest stages of startups. I think, again, speaking in real time, there's some reforecasting happening now for the public companies. Will those be indicators of the belief that tech budgets will start to shrink? That'll be a telltale sign. Salesforce reported last night, things look good. They didn't change guidance. They're up 12% today, so that's a good sign for software overall. Again, I think from a high level strategic standpoint, there will be a massive focus on efficiency versus just growth at all costs. That makes sense. That's a cyclical thing that comes back around. No big deal. I think it leads to better companies. I personally don't see this as bad as an 2008 crash. Back then, tech software was much more capital intensive. Now everything is cloud-based, less barriers to entry. Software is now viewed as an efficiency gain, expense reduction, productivity increaser, versus just a nice to have. And I think, from again, the York IE standpoint, we're going to remain disciplined, stick to our philosophy that, we invest in high growth potential early stage startups, right? And that we fully understand that requires investment and capital burn in order to go, scale a company. But founders need to really realize that the risk of not hitting targets that they put forth in a fundraise process will have a greater impact than it may have, 6 months to a year ago. So you need to be really locked in on your targets and your goals and your metrics. So listen, good companies are still going to get funded without a doubt. That will always happen. There's still plenty of capital in the private markets. That will be the case for the, at least midterm. Good companies remain to have good options, right? Optionality is key here. So certainly not a doom and gloom perspective from us by any means. It's a little bit of a recheck on multiples and valuations. That's probably healthy for the market between both founders and investors. During these sort of interesting times, I think you see some of the most innovative and best companies actually get built. So we're super excited. We're super bullish. We're going to continue to invest again in early stage B2B enterprise software companies, and we expect our portfolio to continue in that upward motion as well. So more to come.
A famous line in the banking business is you make good loans in bad times and bad loans in good times, right? When everything's running, people can get money, it's easy, everything looks good. But when things slow down, you pick the best companies, you pick the best investments. People who are doing it right are always going to find capital.
Excellent. So we'll wrap it on that very positive note, but I really appreciate all of your contributions today. Thank you. We're really looking forward to having this as a resource for entrepreneurs, tech entrepreneurs throughout the state to turn to. As Stephanie mentioned, we will be adding this webinar to the site of the Tech Alliance's site. And we hope that those that are viewing will join us over the next 2 weeks. So on June 8th, we'll be focusing on how to successfully pitch to investors and raise capital. And on June 15th, we'll be focusing on once you bring in the funding, how do you effectively spend the money that was raised? So we'll certainly be fleshing out this topic as we go over the next couple of weeks. But thank you again, Joe, Kendra, and Joe for joining us today. And thank you to the audience for your questions.